The number of shares of common stock, zero point zero 0.01 par value, issued and outstanding as of May 11, 2026, was 17,406,518. The company's revenues arise from the sale of laser consoles, delivery devices, consumables, service, and support activities. The company also derives its revenue from royalties from third parties that are typically based on the licensee's net sales of products that utilize our technology. The company's revenue is recognized in accordance with Accounting Standards Codification, or ASC, Topic 606, Revenue from Contracts with Customers. The company recognizes revenue using the five-step model: 1. Identifying the contract with the customer; 2. Identifying the performance obligations in the contract; 3. Determining expected transaction price; 4. Allocating the transaction price to the distinct performance obligations in the contract; and 5. Recognizing revenue when or as the performance obligations are satisfied. The company has the following revenue transaction types: 1. Product sale only; 2. Service contracts; 3. System repairs outside of warranty; 4. Royalty revenue; and 5. Exclusive distribution rights. Product sale only. The company's products consist of laser consoles, delivery devices, and consumable instrumentation, including laser probes. The company's products are currently sold for use by ophthalmologists specializing in the treatment of glaucoma and retinal diseases. Inside the United States and Germany, the products are sold directly to end users. Outside of the United States and Germany, the company utilizes independent third-party distributors to market and sell the company's products. There is no continuing obligation after shipment is made to these distributors. The company recognizes revenue from product sales at a point in time subject to the allocation of transaction price to additional performance obligations, if any. Service contracts. The company offers a standard 2-year warranty on all system sales. The company also offers a service contract, which is sold to customers in incremental 1-year periods that begin subsequent to the expiration of the standard 2-year warranty. The customer can opt to purchase the service contract at the time of the system sale or after the initial system sale. The company recognizes revenue from service contracts ratably over the service period. Revenue recognition for the sale of a service contract is largely dependent on the timing of the sale as follows. Service contract sale in conjunction with system sale. If the customer opts to purchase a service contract at the time of the system sale, the company allocates the transaction price of the distinct performance obligations in the contract by determining standalone selling price using historical pricing net of any variable consideration or discounts to specifically allocate to a particular performance obligation. Service contract sale subsequent to system sale. If the customer opts to purchase a service contract after the initial system sale, the company determines the amount of time that has elapsed since the initial system sale. If the service contract is purchased within 60 days of the initial sale, the company considers this sale to be an additional element of the original sale and allocates the transaction price of the distinct performance obligations in the contract by determining standalone selling price using historical pricing net of any variable consideration or discounts to specifically allocate to a particular performance obligation. If the service contract is purchased subsequent to 60 days after the initial sale, the sale of the service contract is deemed a separate contract and is deferred at the selling price and recognized ratably over the extended warranty period as the performance obligation is satisfied. System repairs outside of warranty. Customers will occasionally request repairs from the company subsequent to the expiration of the standard warranty and outside of a service contract. The company recognizes revenue from system repairs outside of warranty at a point in time when the customer requests repairs from the company subsequent to the expiration of the standard warranty and outside of a service contract. These repair contracts are considered separate from the initial sale. As such, revenue is recognized as the repair services are rendered and the performance obligations satisfied. Royalty revenue. The company has royalty agreements with 2 customers related to the sale of the company's intellectual property. Under the terms of these agreements, the customers are to remit a percentage of sales to the company as sales occur. The arrangements with the 2 customers are for sales-based licenses of intellectual property, for which the guidance in paragraph ASC 606-10-55-65 applies. Therefore, the company recognizes revenue at a point in time only as the subsequent sale occurs. However, because such sales are reported by the licensees 1 quarter in arrears, the company recognizes such revenue at the time it is reported and paid by the licensees, given that any estimated variable consideration would have to be fully constrained due to the unpredictability of such estimate and the unavoidable risk that it may lead to significant revenue reversals. 5. Exclusive distribution rights. On March 2, 2021, the company and Topcon Corporation, Topcon, entered into a distribution agreement, pursuant to which the company granted Topcon the exclusive right to distribute the company's retina and glaucoma products in certain geographies outside the United States. The exclusivity arrangement with Topcon obligates the company to provide training, customer support, and exclusive territorial rights to Topcon for certain international regions for a period of 10 years, commencing upon regulatory approval to transfer existing, non-exclusive distribution rights from the current distributors in those regions to Topcon. The company has the right to terminate the exclusive distribution rights granted to Topcon for any of the regions at any point in time during the 10-year exclusivity term for a termination fee that is based on a multiple of 1.2 times the revenue generated by the company in 2019 for the respective region. Management has determined that the exclusivity rights, training, and customer support represents a single combined performance obligation for each region, to be recognized as exclusivity fee revenue on a straight-line basis over the 10-year period for each region, commencing on the date that regulatory approval is obtained for each region, based on the standalone selling price for such combined performance obligation for each region. The estimated fair value of the exclusive distribution rights for all regions combined totaled approximately $14.8 million. Of this amount, management has fully constrained and returned to Topcon the arrangement fee allocated to Belarus, approximately $0.2 million, because obtaining the necessary regulatory approvals and termination of existing distributor relationship was not feasible. For each of the 3 months ended April 4, 2026 and March 29, 2025, $0.4 million in revenue related to the exclusive distribution rights was recorded. Costs of obtaining revenue contracts. The company recognized assets from certain costs incurred to obtain revenue contracts. These costs relate to sales commissions arising from the sale of our products. The costs are considered incremental and recoverable costs of obtaining revenue contracts with customers. These deferred costs are amortized on a straight-line basis over the estimated period of benefit, which typically ranges from 2 to 3 years. As of April 4, 2026, the company had fully recognized deferred costs incurred to obtain revenue contracts with customers, which amounts were previously included in prepaid expenses and other current assets and other long-term assets in the company's condensed consolidated balance sheet. Amortization expense was $0,000 and $19,000, respectively, for the 3 months ended April 4, 2026 and March 29, 2025. There were no impairment expenses during each of the 3 months ended April 4, 2026 and March 29, 2025. Sales commissions that do not represent incremental and recoverable costs of obtaining a contract are expensed as incurred. As a practical expedient, the company will not recognize such sales commission as a contract asset, but rather recognize as expense when incurred if the amortization period of the asset that the company would have otherwise recognized is 1 year or less. Contract fulfillment costs. The company recognized an asset from the costs incurred to fulfill a contract. These costs relate directly and must be incurred to satisfy performance obligations on certain specific contract with a customer. These costs are expected to be recovered over time and are amortized on a systematic basis that is consistent with the recognition of revenue to which it relates. As of April 4, 2026, the company recognized deferred costs incurred to fulfill a contract with a customer, net of accumulated amortization, of $0.5 million, and included these amounts in prepaid expenses and other current assets and other long-term assets in the company's condensed consolidated balance sheets. Amortization expense was $21,000 for each of the 3 months ended April 4, 2026 and March 29, 2025. There were no impairment expenses for each of 3 months ended April 4, 2026 and March 29, 2025. The company determines if an arrangement is a lease at inception. Operating leases are included in operating lease right of use (ROU) assets, net, and operating lease liabilities in the company's condensed consolidated balance sheets. As of April 4, 2026 and January 3, 2026, the company was not a party to any finance lease arrangements. ROU assets represent our right to use an underlying asset for the lease term, and lease liabilities represent our obligation to make lease payments arising from the lease. Operating lease ROU assets and liabilities are recognized at the commencement date based on the present value of lease payments over the lease term. As most of the company's leases do not provide an implicit rate, the company uses its incremental borrowing rate based on information available at the commencement date in determining the present value of lease payments. The company uses the implicit rate when readily determinable. The operating lease RU asset also includes any lease payments made and excludes lease incentives. The company's lease terms may include options to extend or terminate the lease when it is reasonably certain that the company will exercise that option. Lease expense for lease payments is recognized on a straight-line basis over the lease term. Under the available practical expedient, the company accounts for the lease and non-lease components as a single lease component. Concentration of credit risk and other risks and uncertainties. The company's cash and cash equivalents are deposited in demand and money market accounts. Deposits held with banks may exceed the amount of insurance provided on such deposits. Generally, these deposits may be redeemed upon demand. The company markets its products to distributors and end users throughout the world. Sales to international distributors are generally made on open credit terms and letters of credit. Management performs ongoing credit evaluations of the company's customers and maintains a provision for potential credit losses. Historically, we have not experienced any significant losses related to individual customers or a group of customers in any particular geographic area. For the 3 months ended April 4, 2026 and March 29, 2025, one customer, Topcon, accounted for more than 10% of total revenues, representing 27% and 30% respectively. For the 3 months ended April 4, 2026 and March 29, 2025, one customer, Topcon, accounted for over 10% of our accounts receivable, representing 19% and 29% respectively. Taxes collected from customers and remitted to governmental authorities. Taxes collected from customers and remitted to governmental authorities are recognized on a net basis in the accompanying condensed consolidated statements of operations. Shipping and handling costs. The company's shipping and handling costs billed to customers are included in revenues, and the associated expense is recorded in cost of revenues for all periods presented. Deferred revenue represents contract liabilities and exclusivity fees. Revenue related to service contracts is deferred and recognized on a straight-line basis over the period of the applicable service contract. Costs associated with these service arrangements are recognized as incurred. Revenue related to exclusivity fees is deferred and recognized over the related exclusivity period. A reconciliation of the changes in the company's deferred revenue balance for the 3 months ended April 4, 2026 and March 29, 2025 is as follows. During the 3 months ended April 4, 2026 and March 29, 2025, approximately $0.4 million and $0.6 million were recognized pertaining to amounts deferred as of January 3, 2026 and December 28, 2024, respectively. As of April 4, 2026, approximately $6.4 million of the non-current portion of deferred revenue and $1.5 million of the current portion of deferred revenue pertain to exclusivity distribution rights deferred revenue. The company currently provides a 2-year full warranty on its products. The associated costs of these warranties are accrued for upon shipment of the products. The company's warranty policy is applicable to products which are considered defective in their performance or fail to meet the product specifications. Warranty costs are reflected in the condensed consolidated statements of operations as cost of revenues. As warranty reserves do not meet the criteria to have separate captions on the face of the condensed consolidated balance sheet, the company has removed these captions and included those amounts in other current and long-term liabilities. Implementation costs incurred in a cloud computing service arrangement. The company's enterprise resource planning, or ERP system, operates in a cloud-based environment. The company concluded that this cloud computing arrangement does not include a license and therefore has accounted for this arrangement as a service contract. The company capitalized $1.1 million in implementation costs and began utilizing the ERP system near the end of the third quarter of 2023 and is recognizing amortization of the capitalized implementation costs over 5 years on a straight-line basis. Amortization expense was approximately $57,000 for each of the 3 months ended April 4, 2026 and March 29, 2025. Variable interest entities. As of April 4, 2026, the company consolidated a foreign subsidiary in accordance with accounting standards for consolidation of variable interest entities, VIEE. The company consolidates the subsidiary because it is the primary beneficiary. Non-controlling interests in the entity were immaterial as of April 4, 2026 and January 3, 2026, respectively. The company will consolidate certain general and administrative expenses of this subsidiary. The consolidated total assets and liabilities related to the above consolidated VIE, net of intercompany eliminations, were $120,000 and $74,000, respectively, as of April 4, 2026. The consolidated total assets and liabilities related to the above consolidated VIE, net of intercompany eliminations, were both $174,000 as of January 3, 2026. The company's financial risk in the VIE primarily includes its equity investment in the VIE and liabilities related to an office lease. Recently adopted accounting standards. In July 2025, the FASB issued ASU 2025-05, Financial Instruments, Credit Losses, Topic 326, Measurement of Credit Losses for Accounts Receivable and Contract Assets, providing a practical expedient available for all entities to assume that current conditions as of the balance sheet date remain unchanged for the asset's remaining life. This update became effective for fiscal years beginning after December 15, 2025, and interim periods within those annual reporting periods. The adopted ASU had no material impact on the company's condensed consolidated financial statements. Recent accounting standards not yet adopted. In November 2024, the FASB issued ASU 2024-03, Income Statement, Reporting Comprehensive Income, Expense Disaggregation Disclosures, Subtopic 220-40, Disaggregation of Income Statement Expenses, which requires disclosure of disaggregated information about certain income statement expense line items on an annual and interim basis. This update will be effective for fiscal years beginning after December 15, 2026, and interim periods within fiscal years beginning after December 15, 2027. Early adoption is permitted. As this accounting standard only impacts disclosures, it will not have a material impact on the company's consolidated financial statements. 3. Accounts receivable and provision for credit losses. The company has trade receivables with various individual customers, such as private businesses, hospitals, universities, government and nonprofit entities, and distributors. The company has determined that geography is the similar risk characteristic to pool its trade receivables balances, and accordingly, groups such balances into either the domestic pool or the international pool. The domestic pool is primarily comprised of individual customers, and the international pool is primarily comprised of distributors. The provision for credit losses represents an estimate of the lifetime expected credit losses inherent in trade receivables as of the consolidated balance sheet date. The company assesses the adequacy of the provision for credit losses on a quarterly basis, based on historical information and current economic conditions and forecasts. Subsequent changes in the provision for credit losses are recorded in current earnings, and reversal of previous losses are permitted under the current guidance. While the company believes it has exercised prudent judgment and applied reasonable assumptions, there can be no assurance that in the future, changes in economic conditions or other factors would not cause changes in the financial health of its customers. If the financial health of the company's customers deteriorates, the timing and level of payments received could be impacted and therefore could result in a change to the company's estimated losses. 4. Related party, Topcon. As of April 4, 2026, Topcon holds a 9.3% voting interest in the company. It currently does not have significant influence over the company's operations. Topcon resells certain of our products as our exclusive distributor in certain international regions. At the same time, the company also purchases certain raw materials from Topcon. During the 3 months ended April 4, 2026, the company's revenues related to Topcon amounted to approximately $3.2 million, including $0.4 million in recognized exclusive distribution rights revenue. During the 3 months ended March 29, 2025, the company's revenues related to TopCon amounted to approximately $3.6 million, including $0.4 million in recognized exclusive distribution rights revenue. The company's purchases from TopCon during the 3 months ended April 4, 2026, amounted to approximately $0.3 million. As of April 4, 2026, the amounts receivable from and payable to TopCon were $1.6 million and $0.3 million, respectively. As of January 3, 2026, the amounts receivable from and payable to TopCon were $1.9 million and $0.1 million, respectively. Goodwill and intangible assets. The carrying value of goodwill was $1.0 million as of both April 4, 2026 and January 3, 2026. Goodwill represents the excess of the purchase price over the fair value of the net tangible and identifiable intangible assets acquired in a business combination. The company reviews goodwill for impairment on an annual basis or whenever events or changes in circumstances indicate the carrying value may not be recoverable. The company performs an annual impairment test by comparing the fair value of a reporting unit with its carrying amount. An impairment charge should be recognized for the amount by which the carrying amount exceeds the reporting unit's fair value. However, the loss recognized should not exceed the total amount of goodwill allocated to that reporting unit. In addition, income tax effects from any tax-deductible goodwill carrying amount of the reporting unit should be considered when measuring the goodwill impairment loss, if applicable. The company has determined that it has a single reporting unit for purposes of performing its goodwill impairment test. As the company uses the market approach to assess impairment, its common stock price is an important component of the fair value calculation. If the company's common stock price continues to experience significant price and volume fluctuations, this will impact the fair value of the reporting unit and can lead to potential impairment in future periods. The company performed its annual impairment test during the second quarter of fiscal year 2025 and determined that its goodwill was not impaired. Amortization expense was $80,000 and $84,000, respectively, for the 3 months ended April 4, 2026 and March 29, 2025. 7. Fair value measurements. Fair value is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The fair value hierarchy distinguishes between 1. Market participant assumptions developed based on market data obtained from independent sources, observable inputs, and 2. An entity's own assumptions about market participant assumptions developed based on the best information available in the circumstances, unobservable inputs. The fair value hierarchy consists of 3 broad levels, which gives the highest priority to unadjusted quoted prices in active markets for identical assets or liabilities, level 1, and the lowest priority to unobservable inputs, level 3. The 3 levels of the fair value hierarchy are described below. Level 1. Quoted prices unadjusted in active markets that are accessible at the measurement date for assets or liabilities. Level 2. Directly or indirectly observable inputs as of the reporting date through correlation with market data, including quoted prices for similar assets and liabilities in active markets and quoted prices in markets that are not active. Level 2 also includes assets and liabilities that are valued using models or other pricing methodologies that do not require significant judgment, since the input assumptions used in the models, such as interest rates and volatility factors, are corroborated by readily observable data from actively quoted markets for substantially the full term of the financial instrument. Level 3. Unobservable inputs that are supported by little or no market activity and reflect the use of significant management judgment. These values are generally determined using pricing models for which the assumptions utilize management's estimates of market participant assumptions. In determining fair value, the company utilizes valuation techniques that maximize the use of observable inputs and minimize the use of unobservable inputs to the extent possible, and considers counterparty credit risk in its assessment of fair value. The carrying amounts of the company's financial assets and liabilities, including cash and cash equivalents, accounts receivable, accounts payable, and accrued expenses as of April 4, 2026 and January 3, 2026, approximate fair value because of the short maturity of these instruments. As of April 4th, 2026 and January 3rd, 2026, financial assets measured and recognized at fair value on a recurring basis and classified under the appropriate level of the fair value hierarchy as described above were as follows, in thousands. The company's Level 1 financial assets are money market funds whose fair values are based on quoted market prices. The company does not have any Level 2 and Level 3 financial assets or liabilities. 8. Leases and commitments and contingencies. The company's operating leases consist of facility and office equipment leases. Operating lease expenses was $6.3 million for each of the 3 months ended April 4th, 2026 and March 29th, 2025. Cash paid for operating leases totaled $0.3 million for both the 3 months ended April 4th, 2026 and March 29th, 2025. As of April 4th, 2026, the weighted average discount rate used in calculating the present value of lease payments was 5.8%. As of April 4th, 2026, the weighted average remaining lease term for the operating leases was 1.1 years. The following represents maturities of operating lease liabilities as of April 4th, 2026, in thousands. Purchase commitments. The company's purchase commitments consist primarily of non-cancelable purchase commitments with vendors to manufacture certain components and ophthalmic instrumentation. As of April 4th, 2026, the company's future minimum payments through fiscal year 2028 for its purchase commitments were approximately $27.4 million, with $27.3 million committed for the next 12 months. The company enters into standard indemnification arrangements in the ordinary course of business. Pursuant to these arrangements, the company indemnifies, holds harmless, and agrees to reimburse the indemnified parties for losses suffered or incurred by the indemnified parties, generally the company's business partners or customers, in connection with any trade secret, copyright, patent, or other intellectual property infringement claim by any third party with respect to the company's products. The term of these indemnification agreements is generally perpetual any time after the execution of the agreement. The maximum potential amount of future payments that we could be required to make under these agreements is not determinable. The company has never incurred costs to defend lawsuits or settle claims related to these indemnification agreements. As a result, the company believes the estimated fair value of these agreements is minimal. The company has entered into indemnification agreements with its directors and officers that may require the company to indemnify its directors and officers against liabilities that may arise by reason of their status or service as directors or officers, other than liabilities arising from willful misconduct of a culpable nature. These agreements also require the company to advance their expenses incurred as a result of any proceeding against them as to which they could be indemnified, and to make a good faith determination whether or not it is practicable for the company to obtain directors and officers insurance. The company currently has directors and officers liability insurance. From time to time, the company may be involved in legal proceedings arising in the ordinary course of business. Although the results of litigation and claims cannot be predicted with certainty, the company currently believes that the final outcome of these ordinary course matters will not have a material adverse effect on the company's condensed consolidated operating results, financial condition, or cash flows. Regardless of the outcome, litigation can have an adverse impact on the company because of defense and settlement costs, diversion of management resources, and other factors. 9. Convertible preferred shares and convertible debt. On March 18, 2025, the company filed a certificate of designation, preferences and rights of the Series B preferred stock, the Series B certificate of designation, authorizing the company to issue up to 1 million shares of authorized undesignated preferred stock as shares of Series B preferred stock, par value 0.01 per share, the Series B preferred stock. At the company's annual meeting of stockholders held on June 11, 2025, the annual meeting, the company's stockholders approved an amendment and restatement of the company's amended and restated certificate of incorporation, the charter, in the form of the amended and restated certificate of incorporation, the restated charter, which, among other matters, authorized 1 million shares to be designated as Series B preferred stock and 1 million shares to be undesignated preferred stock for a total of 2 million shares of preferred stock, and reestablished the designations, powers, preferences, and relative and other special rights, and the qualifications, limitations, and restrictions of the preferred stock, including the company's Series B preferred stock, which, with respect to the Series B preferred stock, and except as noted in the company's definitive proxy statement filed with the SEC on April 28, 2025, and as supplemented by its definitive additional materials filed with the SEC on May 20, 2025, and June 2, 2025, are substantially the same rights for the Series B preferred stock as are provided for pursuant to the Series B Certificate of Designation. Following the stockholders' approval of the form of restated charter, the company filed the restated charter with the Secretary of State of the State of Delaware on June 11, 2025. Also, with the approval of the restated charter, certain provisions related to the Series B preferred stock were revised, allowing the Series B preferred stock to meet the definition of permanent equity from an accounting perspective. As a result, the company reclassified the Series B preferred stock from mezzanine equity to permanent equity in the second fiscal quarter of 2025. On March 19, 2025, the company entered into a securities purchase agreement, the Novel Securities Agreement, and a note purchase agreement, the Novel Note Purchase Agreement, with Novel Inspirational International Co., Limited, on Novel. Pursuant to the Novel Securities Agreement and the Novel Note Purchase Agreement, the company issued 600,000 shares of its Series B preferred stock at $10 per share, initially convertible into 3 million shares of the company's common stock, par value 0.01 per share, and an initial convertible promissory note in an aggregate principal amount of $4 million, the initial Novel Note. The initial Novel Note is convertible into 400,000 shares of the company's Series B preferred stock. Concurrently, with the purchase of the shares of Series B preferred stock and the initial Novel Note, the company also entered into an investor rights agreement and an amendment to the investor rights agreement, together the rights agreement, with Novel, pursuant to which the company has agreed to, among other matters, grant Novel certain rights, including I. Registration rights and indemnification obligations related thereto, subject to certain restrictions, including satisfying certain beneficial ownership thresholds, the right to appoint and maintain 2 individuals to the company's board of directors, and m. the right to approve certain corporate actions of the company. The initial Novel Note has a 36-month term and will bear interest at 12% per annum. Interest on the initial Novel Note will be payable quarterly on the first business day of each calendar quarter, beginning on July 1, 2025, in a number of shares of the common stock equal to I, the accrued and unpaid interest due on the applicable interest payment date, divided by I, the greater of A, the average closing price of the common stock for each trading day after March 19, 2025, in the calendar quarter immediately preceding such interest payment date, and B, a price floor of $0.21. The initial Novel Note is convertible at Novel's option into shares of the Series B preferred stock at an initial conversion price of $10, subject to adjustments set forth in the initial Novel Note. In addition, the company incurred $0.4 million in debt issuance costs for the 3 months ended April 4, 2026 and March 29, 2025. Debt issuance costs of $30,000 and negative $4,000, respectively, were recorded on a straight-line basis over the term of the loan. The accretion of debt issuance costs under that method is deemed materially consistent with the effective interest rate method. In addition to the initial Novel Note, Novel has the right to purchase additional convertible promissory notes, the growth notes, in an aggregate principal amount of $10 million. The growth notes are issuable in 3 installments, with 1/3 of the aggregate principal amount issuable upon each yearly anniversary. As of April 4, 2026, the company has not issued any growth notes. On March 18, 2025, the company also entered into that certain repayment notice, the repayment notice, with Lind Global Asset Management IX LLC, Lind. Pursuant to the repayment notice, and upon the subsequent delivery of a cash payment to Lind in the amount of $3,330,999.99, the company thereafter fully discharged its outstanding obligations, other than certain indemnification obligations that survived, pursuant to the terms of the repayment notice, under that certain securities purchase agreement, dated August 4, 2024, by and between the company and Lind, and terminated the senior convertible promissory note dated August 7, 2024, issued by the company to Lind thereunder, the Lind note. As a result of the early repayment of the Lind note on March 19, 2025, the company recognized a loss of $1.3 million on the extinguishment of the convertible note payable, reflected in the consolidated statements of operations as other expense net. 10. Stock-based compensation. The company accounts for stock-based compensation granted to employees and directors, including stock option awards, restricted stock and restricted stock units, RSUs, in accordance with FASB ASC Topic 718, Compensation, Stock Compensation. Accordingly, stock-based compensation cost is measured at grant date based on the fair value of the award and is recognized as an expense over the employee's service period. The company recognizes compensation expense on a ratable basis over the requisite service period of the award. The company's stockholders approved an amendment to the amended and restated 2008 Equity Incentive Plan, the plan, at the annual stockholders meeting in June 2025, which, among other things, added 1 million shares to the plan and extended the term of the plan. The company values options using the Black-Scholes option pricing model. Time-based RSUs are valued at the grant date fair value of the underlying common shares. Performance-based RSUs without market conditions are valued at grant date fair value of the underlying common shares. Performance-based RSUs granted with market conditions and performance-based stock options with market conditions are valued using the Monte Carlo simulation model. The Black-Scholes option pricing model requires the use of highly subjective and complex assumptions which determine the fair value of stock-based awards, including the option's expected term and the price volatility of the underlying stock. The Monte Carlo simulation model incorporates assumptions for the holding period, risk-free interest rate, stock price volatility, and dividend yield. 2008 Equity Incentive Plan, as amended. The terms of awards granted during the 3 months ended April 4, 2026, were consistent with those described in the consolidated financial statements included in our annual report on Form 10-K for the year ended January 3, 2026. Stock-based compensation expense capitalized to inventory was immaterial for the 3 months ended April 4, 2026 and March 29, 2025. As of April 4, 2026, there was $0.9 million of total unrecognized compensation cost, net of expected forfeitures, related to non-vested stock-based compensation arrangements. The cost is expected to be recognized over a weighted average period of 1.7 years. Provision for income tax. The company calculates its interim tax provision in accordance with the provisions of ASC Topic 740-270, Income Taxes, Interim Reporting. For interim periods, the company estimates its annual effective income tax rate and applies the estimated rate to the year-to-date income or loss before income taxes. The company also computes the tax provision or benefit related to items reported separately and recognizes the items net of their related tax effect in the interim periods in which they occur. The company also recognizes the effect of changes enacted in tax laws or rates in the interim periods in which the changes occur. The company recorded a provision for income tax of $58,000 and $12,000 for the 3 months ended April 4, 2026 and March 29, 2025, respectively. Deferred income taxes. The company accounts for income taxes in accordance with ASC Topic 740, Income Taxes, Can't All Acquidizing, which requires that deferred tax assets and liabilities be recognized using enacted tax rates for the effect of temporary differences between the book and tax bases of recorded assets and liabilities. ASC 740 also requires that deferred tax assets be reduced by a valuation allowance if it is more likely than not that some or all of the deferred tax assets will not be realized. As of the first quarter of fiscal year 2026, based on the company's recent history of losses and its forecasted losses, management believes it is more likely than not that a full valuation allowance is required. Accordingly, the company continues to provide a full valuation allowance on its federal and state's deferred tax assets. Uncertain tax positions. The company accounts for its uncertain tax positions in accordance with ASC 740. As of January 3, 2026, the company had $1.4 million of unrecognized tax benefits and none of the unrecognized tax benefits would result in a change in the company's effective tax rate if recognized in future years. On July 4, 2025, President Trump signed the Tax Act referred to as the One Big Beautiful Bill, OBBB Act, which includes comprehensive U.S. corporate tax legislation. The legislation includes the permanent extension and modification of provisions originally introduced under the Tax Cuts and Jobs Act of 2017 and the introduction of new provisions. Key provisions include the permanent restoration of bonus depreciation allowances, changes to the limitations on deductibility of business interest expense, and the reintroduction of immediate expensing of U.S. domestic research and development costs. The impact on current and deferred taxes for tax law changes is reported in continuing operations in the interim period that includes the enactment date. The company has determined that new act would not have a material impact to the company's interim tax provision due to its valuation allowance. The company will continue to assess the tax accounting impacts as well as the various state legislation and conformity rules as more information becomes available. The company is subject to United States federal income tax, as well as to income taxes in state jurisdictions. The company's federal and state income tax returns are open to examination by tax authorities for 3 years and 3 to 5 years, respectively. 12. Computation of basic and diluted net loss per share. Basic and diluted net loss per share is based upon the weighted average number of common shares outstanding during the period. Common stock equivalents consist of incremental common shares issuable upon the exercise of stock options and the release, vesting of RSUs and awards, and are calculated under the treasury stock method. Common stock equivalent shares from unexercised stock options and unvested RSUs and awards are excluded from the computation for periods in which the company incurs a net loss or if the exercise price of such options is greater than the average market price of our common stock for the period, as their effect would be anti-dilutive. Common stock equivalents consisting of incremental common stock issuable upon conversion of convertible debt and preferred shares are calculated under the if converted method. Common stock equivalent shares from convertible debt and preferred shares are excluded from the computation for periods in which the company incurs a net loss or if their effect would be anti-dilutive. For the 3 months ended April 4, 2026 and March 29, 2025, potential shares from stock options and RSUs totaling 2,512,284 and 2,269,639 shares, respectively, were excluded from the computation of diluted weighted average shares outstanding. For each of the 3 months ended April 4, 2026 and March 29, 2025, potential shares from the conversion of convertible debt and preferred shares totaling 5 million were excluded from the computation of diluted weighted average shares outstanding, respectively. 13. Business segments. The company operates in one segment, ophthalmology. The company develops, manufactures, and markets medical devices. The company's revenues arise from the sale of consoles, delivery devices, consumables, service, and support activities. Revenues are attributed to countries based on the location of end customers. The United States accounted for 49.7% and 44.4% of revenues for the 3 months ended April 4, 2026 and March 29, 2025, respectively. Other than the United States, the Netherlands accounted for at least 10% of the company's revenues during the 3 months ended April 4, 2026 and March 29, 2025, representing 15.4% and 13.1%, respectively. IRIDEX is an ophthalmic medical technology company focused on the development and commercialization of breakthrough products and procedures used to treat sight-threatening eye conditions, including glaucoma and retinal diseases. Our proprietary micropulse technology and endpoint management technology are used for the treatment of glaucoma and retina disorders. Both technologies are offered as optional treatment modes in select laser consoles, in addition to the standard continuous wave CW treatment mode. They allow low-energy, sub-visible, tissue-sparing laser therapy by different means. Micropulse technology uses short, microsecond-long laser pulses that allow tissue to cool between pulses, giving physicians finer control of thermal elevation to minimize tissue damage. Endpoint management technology uses a delivery algorithm to titrate the laser energy. CW laser photocoagulation can stabilize vision over the long term, but can also result in varying degrees of vision loss. Both micropulse and endpoint management technologies have demonstrated clinical efficacy with a safer profile compared to standard high-energy CW laser for the treatment of retinal diseases and glaucoma. Our products consist of laser consoles, delivery devices, and consumable probes. Our laser consoles consist of the following product lines. Glaucoma. Our primary glaucoma console line is the Cyclo G6 Regal laser system with micropulse technology. In addition, our medical retina consoles have features supporting glaucoma laser treatments. Medical retina. Our medical retina product line includes our portable IQ532 and IQ577 laser systems with micropulse technology, and the pattern scanning laser Pascal system, an integrated workstation with endpoint management technology and micropulse technology. These systems are ideal for multi-specialty practices because these lasers also can be used to treat glaucoma, i.e., single-spot laser trabeculoplasty using micropulse technology, iridotomy, and iridectomy using the IQ lasers, and pattern scanning laser trabeculoplasty, PSLT, using the Pascal laser system. Surgical retina. Our surgical retina product line includes our Oculite TX and Oculite SLX with micropulse technology, laser photocoagulation systems. These systems are often used in vitrectomy procedures, which are used to treat proliferative diabetic retinopathy, macular holes, retinal tears, and detachments. Our business generates recurring revenues through sales of consumable products, predominantly single-use laser probe devices and other instrumentation, as well as repair, service, and extended service contracts for our laser systems. Our laser probes consist of the following product lines. Glaucoma. Probes used in our glaucoma product line include our patented single-use delivery devices, MicroPulse P3, G-Probe Reg, and G-Probe Illuminate. Surgical retina. Probes used in our surgical retina product line include our family of single-use EndoProbe Retinae handpieces. Ophthalmologists typically use our laser systems in hospital operating rooms and ambulatory surgical centers, as well as their offices and clinics. In operating rooms and ambulatory surgical centers, ophthalmologists use our laser systems with either an indirect laser ophthalmoscope or a single-use consumable probe, including MicroPulse P3, G-Probe, and G-Probe Illuminate delivery devices, and EndoProbe handpieces. In the offices and clinics, ophthalmologists use our laser systems with either an indirect laser ophthalmonocrip or a slit lamp adapter. Our proprietary micropulse and continuous wave laser therapies for glaucoma have been adopted by physicians around the globe as effective tools for managing and slowing the progression of glaucoma. Our products are sold in the United States and Germany predominantly through a direct sales force, and internationally, aside from Germany, Italy, UK, glaucoma, India, and other smaller markets, primarily through Topcon Corporation, Topcon, and other independent distributors. Sales to international distributors are made on open credit terms or letters of credit and are currently denominated in US dollars and accordingly are not subject to risks associated with currency fluctuations. However, increases in the value of the US dollar against any local currencies could cause our products to become relatively more expensive to customers in a particular country or region, leading to reduced revenue or profitability in that country or region. Sales to direct end users transacted through our German office are denominated in euros and are subject to risks associated with currency fluctuations. Our overall manufacturing strategy is to continuously develop and refine our processes to achieve our objectives of continuity of supply, quality of supply, and margin enhancement. Over time, this may lead to insourcing or outsourcing certain functions in various geographic locations to achieve our objectives. Cost of revenues consists primarily of our direct manufacturing costs, which include the cost of components and subsystems, assembling, packaging, shipping, and testing components at our facility, direct labor and associated overhead, warranty, royalty, and amortization of intangible assets, and depot service costs. For certain of our products, we are responsible for the cost of the fully assembled product that is manufactured by a third party. Research and development expenses consist primarily of personnel costs, materials to support new product development and research support provided to clinicians at medical institutions developing new applications which utilize our products, and regulatory expenses. Research and development costs have been expensed as incurred. Sales and marketing expenses consist primarily of costs of personnel, sales commissions, travel expenses, advertising and promotional expenses. General and administrative expenses consist primarily of costs of personnel, legal, accounting, and other public company costs, insurance, and other expenses not allocated to other departments. Impact of macroeconomic conditions to our business. Current macroeconomic conditions exhibit challenges that can affect capital equipment purchasing demand and timing, including recessionary fears, tariffs and retaliatory responses, trade wars, conflicts in the Middle East, lapse in government funding, healthcare reform initiatives, unexpected changes in taxes or policies, inflation concerns, changing interest rates, as well as other geopolitical developments and uncertainty, have impacted and may continue to impact business spending and the economy as a whole. As a result, we have seen customers extend purchase decision cycles. The macroeconomic conditions on our business and operations remain uncertain, and it is not possible for us to predict the duration and extent to which they will affect our business, future results of operations, and financial condition. Results of operations. Our total revenues decreased by $0.1 million, or 0.8%, from $11.9 million to $11.8 million. Revenue in our glaucoma and other revenue product groups increased, partially offset by a decrease in our retina products. While we believe that the market for our products remains strong, the overall capital expenditure landscape within hospitals, surgical centers, and physician offices may continue to be negatively impacted by persistent macroeconomic concerns, including those from ongoing geopolitical uncertainties, including the conflicts in the Middle East, tariffs and trade wars, and other factors. Gross profit and gross margin. Gross profit decreased by $0.3 million, or 6.2%, from $5.0 million to $4.7 million. Gross margin decreased by 2.3%, from 42.5% to 40.2%. The decrease in gross margin was primarily due to higher manufacturing costs and increased product costs related to recent tariff developments as the company continues its transition to lower-cost contract manufacturers. Gross margins may fluctuate due to changes in the relative proportion of domestic and international sales, the product mix of sales, introduction of new products, manufacturing variances, total unit volume changes, responses to the evolving macroeconomic and geopolitical uncertainty, conflicts in the Middle East, including tariffs and trade wars, and other factors. Research and development. Research and development expenses remained relatively flat at $0.9 million. This reflects management's continued focus on cost-saving initiatives, including reduced spending on new and expanded product investments. Sales and marketing expenses remained relatively flat at $2.5 million. This also reflects management's continued focus on cost-saving initiatives and maintaining stable spending levels within this function. General and administrative. General and administrative expenses decreased by $0.3 million, or 16.0%, from $1.9 million to $1.6 million. The decrease was primarily attributable to lower consulting costs, reduced deal-related legal expenses, and cost savings realized from the General and Administrative Function Transfer Initiative announced in prior periods. Other income, expense net. Other expense net was $0.1 million for the 3 months ended April 4, 2026, primarily consisting of interest and amortization of loan expenses. Other expense net was $1.5 million for the 3 months ended March 29, 2025, driven primarily by the costs associated with the Lind Note payable settlement. We recorded an income tax provision of $58,000 and $12,000 for the 3 months ended April 4, 2026 and March 29, 2025, respectively. Liquidity, capital resources, and management plans. Liquidity is our ability to generate sufficient cash flows from operating activities to meet our obligations and commitments. In addition, liquidity includes the ability to obtain appropriate financing or to raise capital. As of April 4, 2026, we had cash and cash equivalents of $4.6 million and working capital of $11.8 million, compared to cash and cash equivalents of $6.0 million and working capital of $12.0 million as of January 3, 2026. Net cash used in operating activities was $1.3 million in the 3 months ended April 4, 2026, compared to net cash used in operating activities of $1.1 million in the 3 months ended March 29, 2025. The increase in net cash used in operating activities was primarily due to increase in loss from operations. For the 3 months ended April 4, 2026, net cash used in investing activities was zero. $1 million, which consisted of capital expenditures. For the 3 months ended March 29, 2025, net cash used in investing activities was $11,000, which consisted of capital expenditures. For the 3 months ended April 4, 2026, net cash used in financing activities was $1,000, primarily related to taxes paid to net share settlement of equity awards. For the 3 months ended March 29, 2025, net cash from financing activities was $6.0 million. In the first fiscal quarter of 2025, we received $10 million in issuance of convertible preferred shares and convertible debt, offset by $4.0 million in early prepayment of convertible debt. We have historically funded our operations primarily through sales of our products to customers, sales of our common stock, and borrowing arrangements. As of April 4, 2026, our principal sources of liquidity consisted of cash and cash equivalents of $4.6 million. We have incurred net losses over the last several years, and as of April 4, 2026, have an accumulated deficit of approximately $92.9 million. On March 19, 2025, the company entered into the Novel Securities Agreement and the Novel Note Purchase Agreement with Novel. Pursuant to the Novel Securities Agreement and the Novel Note Purchase Agreement, Novel has the right to purchase additional convertible promissory notes, the growth notes, in an aggregate principal amount of $10 million. The growth notes are issuable in 3 installments, with 1/3 of the aggregate principal amount issuable upon each yearly anniversary after March 19, 2025. We have not issued any growth notes, but may do so in the future. We believe our existing cash and cash equivalents will be sufficient to meet our anticipated cash needs over the next 12 months. Our future capital requirements will depend on many factors, including our growth rates, the timing and extent of our spending to support research and development activities, the timing and cost of establishing additional sales and marketing capabilities, the introduction of new and enhanced products, and our costs to implement new manufacturing technologies. In the event that additional financing is required from outside sources, we may not be able to raise it on terms acceptable to us or at all. Any debt financing obtained by us in the future could also involve restrictive covenants relating to our capital raising activities and other financial and operational matters, which may make it more difficult for us to obtain additional capital and to pursue business opportunities, including potential acquisitions. Additionally, if we raise additional funds through further issuances of equity, our existing stockholders could suffer significant dilution in their percentage ownership of our company, and any new equity securities we issue could have rights, preferences, and privileges senior to those of holders of our common stock. If we are unable to obtain adequate financing or financing on terms satisfactory to us when we require it, our ability to continue to grow or support our business and to respond to business challenges could be significantly limited. Off-balance sheet arrangements. We do not have any off-balance sheet arrangements that have or are reasonably likely to have a material current or future effect on our financial condition, changes in financial condition, revenues or expenses, results of operations, liquidity, capital expenditures, or capital resources. Item 4. Controls and procedures. Evaluation of disclosure controls and procedures. We maintain disclosure controls and procedures, as such term is defined in Rules 13A times 15E or 15D times 15 in the Exchange Act, that are designed to ensure that information required to be disclosed by us in reports that we file or submit under the Exchange Act is recorded, processed, summarized, and reported within the time periods specified in SEC rules and forms, and that such information is accumulated and communicated to our management, including our principal executive officer and our principal financial officer, as appropriate to allow timely decisions regarding required disclosure. In designing and evaluating our disclosure controls and procedures, management recognized that disclosure controls and procedures, no matter how well conceived and operated, can provide only reasonable, not absolute, assurance that the objectives of the disclosure controls and procedures are met. Additionally, in designing disclosure controls and procedures, our management necessarily was required to apply its judgment in evaluating the cost-benefit relationship of possible disclosure controls and procedures. The design of any disclosure controls and procedures also is based in part upon certain assumptions about the likelihood of future events, and there can be no assurance that any design will succeed in achieving its stated goals under all potential future conditions. As required by SEC Rule 13A-15B, we carried out an evaluation under the supervision and with the participation of our management, including our principal executive officer and our principal financial officer, of the effectiveness of the design and operation of our disclosure controls and procedures as of April 4, 2026. Based on the foregoing, our principal executive officer and our principal financial officer concluded that our disclosure controls and procedures were effective at the reasonable assurance level. Changes in internal control over financial reporting. There have been no changes in our internal control over financial reporting that occurred during the period covered by this Form 10-Q that have materially affected or are reasonably likely to materially affect our internal control over financial reporting.